of, I won't tell all the stories, I'll tell a few today, but I can't tell them all, but it is relative to one specific situation we encountered. And it related to a particular club making a very significant investment in a banquet hall using debt, and what occurred after that. And it started us to thinking on return on investment, return on equity, very standard measures of financial and business performance, and what those might mean in a club. And that led us down the path of investigating, and many of the clubs on the webinar today, I'm sure, have participated. But we've been doing a net worth over time benchmark. We've had about 150 clubs now participate in that effort, and it's very enlightening. We'll see a bunch of that information today, but it provides tremendous insight. I think, frankly, it's going to have a fundamental impact on the way clubs view finances over time. And it kind of led us to thinking about, it's during budgeting season now, of course, for many clubs. And it started getting us to think about the budgeting process, and where, again, we've always tried to follow the money at Club Benchmark, and where the money comes from, where it goes. And this is going to be an angle of looking at finances that way, but I think it's a different view, and I think it's going to be a pretty interesting and powerful view. We've often said, clubs too often in the boardroom of a club, I think we tend to, and I am a board member of my own club, but I've been in many club boardrooms other than my own as well, but I think there tends to be this concept of, right and wrong, good, bad, profit's good, loss is bad, we should make money in F&B, the department should be profitable. It's kind of all perspective that relates somewhat back to our daily business life. But I think in clubs, it doesn't work out that way. I think it really does work out that clubs get to make choices, and those choices have profound impact on the outcome. And some clubs might make one choice, let's say, to subsidize F&B significantly, and it could be an absolutely right choice. And some club might make a choice to subsidize it less. So it's a lot less about right and wrong, and it's a lot more about understanding what choices are being made. Many of them are unconscious, but it's understanding those choices that are being made and how they impact the outcome. So this webinar and this approach that we're looking at, the lens we're looking at budgets through, is really, kind of oriented in that direction. It's about choices and choices that have been made. When you think about the budgeting process, I'm sure we have, I know we have many general managers and head of finance, controller, CFOs on the webinar. And I know as well we have many board members and probably many finance committee members. If you all think about the budgeting process at your club and I ask a question, I think I can hear the answer potentially, but I like to wonder where the time is invested in the budgeting process. I've asked many clubs, and if this is more anecdotal, it's not data driven, but it is based on queries of real clubs. You tend to see significantly more emphasis, let's say 80-20, and I think that's being gracious, 80% on the operating budget and 20% on the capital budget. And the way the budgets are derived, I think, tends to be kind of produce a linear or incremental trajectory. It's kind of like we take last year's budget and we build it. We might raise dues X% and try to hold expenses a little less than the dues raised, but tweak them on the margin. Everything's on the margin from where we were last year. And if we do that and we have an eye towards the operating budget as opposed to the capital budget, if we had not enough capital generation, and we would contend with our data that at least half of the clubs in the country at this moment are not generating enough capital, enough necessary capital. So it's likely to be that way in the following year. So that incremental kind of slow linear approach ultimately ends up in change coming slowly. I've heard people mention zero-based budgeting. I think we've been involved in enough clubs to say that I'm not going to say nobody does a zero-based budget, but I think it's very rare to see that actually happen. The usual progression of a budget, it kind of starts with the staff, and then it merges into the staff and the finance committee, which end up presenting to the board and being approved by the board, and ultimately it flows out to the membership. Most typically, it flows out to the membership in terms of what the operating dues increase will be in the coming year. So it's tilted towards operating. And I suggest it's tilted towards expenses in the operating budget. There's many line items, as we all know, in an operating budget. But I hope to show, and I think the data will prove, and it might sound counterintuitive, but it's true, there's much less money in the operating budget than we might think. So we'll ask the question, where is the money? So this is a real club. And what we see here is the operating revenue at this club and the capital income at this club. This club is a bit unique in that it has a pretty significant amount of capital income in relation to its size. More often you'll see clubs' capital income lagging the operating revenue in terms of percentile ranking. But this club is just the opposite. But we'll continue to, it's a good club to use for that reason, actually. So the club has 3.8, we'll call it 3.9 rounding, 3.9 million operating revenue, about $500,000 in capital income. Most clubs, our data would suggest about 75%, give or take, of clubs set their operating budget to break even. So when you look at that operating budget and you think about money that has an impact on the club, the operating budget is going to end up being around zero. And there's two slides here that basically prove that point. This is for clubs with golf. I just wanted to use one common set. The same thing is true with clubs without golf. There's about 800 clubs on this slides that you see here. This particular club had a $39,000 operating deficit last year, which is essentially break even. It's a 1% operating deficit in terms of margin, which is just the total dollars divided by the total dollars of revenue. And if you look at the slide in the lower right corner, what you see is the 50%, so the 25th percentile to the 75th, that's 50% of the club, so 400 clubs. That operating bottom line is between -3% and +4% of the revenue, essentially hovering around break even, to the point I made earlier. On the left, in the lower quartile, you do see that there's about a quarter of the clubs that have what we'll call a substantive or substantial operating deficit. And on the right, you'll see there's about a quarter of the clubs that have a substantive or substantial operating surplus. Those clubs make a conscious choice to do that because they actually use the operating ledger to help fund capital resources. From the data we've gathered, and I actually have this in the slide coming up, about half of that quarter of the clubs with the significant operating surplus make that choice by what's called funding depreciation, which means they set their operating dues to fund the depreciation expense, and that's about 18% of clubs, whereas 82% of clubs don't do that. So you get three buckets. You get clubs that have a significant operating deficit. You get that middle swath, 50% of clubs that have around operating break even, and then some have, what we'll call a substantive operating surplus. What I'd like to do is look at that same chart that shows the operating bottom line in terms of margin. This is the blue line on this chart. So it's the percentage of the operating revenue that makes it to the bottom line, the operating bottom line, and compare that to the capital income as a percent of revenue. So as you look at this, what you see is the money that flows through the operating budget is essentially flat. There is none. There really is no money flowing through the operating budget. But in terms of the operating revenue, a significant amount of money is flowing in the capital budget, capital income. The median is 13% capital income to revenue, whereas the median operating margin is break even, 0%. So when we think in terms of, I'm going to link this to budgeting, but when we think about the money that will propel a club forward in the future, it's the capital income that propels clubs forward. In clubs that are situated at this point in time with weak capital income. As you can see, there's about 5% of the clubs on the left of that chart that have very weak capital income. They have a very weak engine to propel them into the future because they can't make capital investment. If you look at the right, the 75th percentile, 20% and above. So there's a quarter of the clubs in North America, I'll say, because we have a bunch of clubs in Canada too, where the capital income is a significant portion of that operating revenue. These are clubs that have a significant engine to drive them or propel them into the future because they can make significant capital investment, not only in repair and replacement, but in extending and broadening the value proposition by investing in added and new services and amenities. So to summarize this chart, which is critical, clubs tend to break even on the operating budget, which is a very logical thing. And the theory is that the economic engine to propel forward is on the capital budget. And this chart proves that point. I just want to show you how we organize the database. This is our financial insight model. We have an operating ledger. We have a capital ledger. We get an operating bottom line for every club on the database every year, both the operating bottom line and the capital bottom line. The capital bottom line we refer to as net available capital. Net available capital is simply earnings before depreciation, taxes, and amortization. It's after covering interest expense, though, on debt. Net available capital is the most critical metric or measure, we believe, in club finances. Right, that's our view based on our analysis. It's the amount of money that a club has at the end of the year that it can do one of three things with. It can make capital investment, it could pay down debt, or it could put money in the bank and increase reserves. So net available capital is a critical metric. This club I had mentioned earlier that invested with debt in a banquet facility, we kind of studied it in gory detail, I'll say. And it led us on a path over the last 15, 18 months where we've done an analysis now of 150 clubs of the net worth of the club over time. So any business, whether it's a nonprofit or a for-profit, has to have money to operate, and it needs money to operate and plan for the future, obviously. Businesses can't operate without money. Someone once said to me that not-for-profit is a tax status, not a business model. It's a very good point. Clubs must generate cash, generate money, otherwise they can't plan and invest in the future. So the measure of how well a club is generating money, profit, is the equity. That's true in any business. You pick up any balance sheet for any business, you have assets on one side and you have liabilities and equity on the other side. The equity is the paper of book value, it's sometimes termed, of the business. And I think everyone would agree that the goal of any business is to increase its value over time. Businesses whose value is declining over time are not in a very good place. In a not-for-profit member-owned club, unrestricted net assets is the equivalent of stockholders' equity. It is the paper value or the book value or the net worth of the club. Given, as I just showed with data, that most clubs tend to break even on the operating ledger, you can only increase net worth if you generate enough capital income to overcome the depreciation. So we call that net available capital, and that's the capital that's available after adjusting for your operating results. So net available capital, earnings before depreciation, taxes, and amortization, must be greater than the depreciation expense on the income statement in order for net worth to increase. If it's less than, the net worth will go down, and if it's greater than, the net worth will go up. If it's, and it is driven, as I said, by capital. The only way you can grow the net worth through capital is to garner money from either existing or incoming members. That's it. You know, some clubs, very few, will call on a couple of hands, hold a large enough tournament or a world America's Cup race if you're a yacht club. You know, some clubs might have some event like that that can generate some capital income every 3 to 5 years, but it's still, even in those clubs, it's not the substantial driver. It's an additive driver. The substantial driver in every club is capital contributed to the club either through members who are joining and paying initiation fees of substance, or existing members paying capital dues that recur, or capital assessments that come and go. That's the way you generate capital. And if that capital that is being generated is not greater than the depreciation, the net worth of the club will decrease. This is a club also that has a very precipitous decline in net worth. And as the budgeting process starts, I'd ask this question. Before a club like this starts to dig into its operating budget and start looking at hundreds of line items, would it be important for the members of this club to know this is what's going on at their club? That they see literally the value of their club evaporating overnight. Well, this is a result of our net worth over time study. Carmel Country Club in Charlotte has allowed us to use their data as a benchmark. Let's call it the high bar. And they're a club that's experienced a very consistent, as you can see, a very consistent upward trend in net worth over time. What we measure is the average compounded annual growth rate. So it just says, in the case of Carmel, in 2004, on paper, the club was worth about $11 million. At the end of last year, the club was on paper worth about $33 million. So the average annual growth was 8.7%. And when you look at it in comparison to the club that's seeing the precipitous decline of 15%, obviously those are two very different stories. Something's got to be different at Carmel than at Club XYZ. Club XYZ has about $650,000 of depreciation per year. And if you look at the decline in net worth, what you'll see is in some of the years it approximates the depreciation. That's because the club's not generating capital income. It's a club that has very little initiation fee income as a result of cutting the initiation fee. There's not a recurring pattern of capital dues or assessments, so the club's depreciation is overwhelming its income, and it sees its decline. On this chart, you see all 150 or so clubs that we've garnered this data from. And what we did is we indexed the net worth over time to a baseline of 100, which is indicated by the thick black line. So clubs who have a line that is near that black line are clubs whose net worth is flat over time. In clubs, by the way, about a third of the clubs are under the black line, which means a third of the clubs, the net worth is decreasing over time. And then if you look to the top, you see Carmel. Carmel actually has the third highest average annual growth rate over this period of time from 2004 to 6, and that period is where we've gathered the data of all 150 clubs. I had a theory when we first gathered the data, having known the club fairly well, that they would probably end up with a net worth increase over time, and we'll explain how that happened. That would be best in class, quote unquote, and clearly you can see that it stands up to this point. And I'm going to guess as we get data from another 150 clubs in the next couple of months, it will stand up. So the clubs that are at the upper end of this obviously are experiencing more robust growth rates in net worth over time. And the reason for that is they were able to generate enough net available capital to not only meet, but to overwhelm the depreciation number, which is an important consideration, which we'll dig into in some real detail. So, you know, when you think about budgeting now, budgeting is about trying to understand the ins and the outs of the business, the revenue and the expenses, and given that the goal of every business is to get money to the bottom line to increase its value or its net worth, it would be very critical in the budgeting process to understand the net worth of the business, to understand where it is at a point in time, and to understand how it will be at a better point in the future. And my guess is that if, the 3,000 or 4,000 clubs, that we deal with as they begin the budgeting process this year, very few of them start with that view. In fact, it's maybe a handful. I think it's an imperative part of the process, and I think actually we'll see in a minute it can change the way members view the budgeting process. What if we were to start the budgeting process, instead of thinking about line items in an operating budget, which are going to wash out to break even, what if we started the budgeting process by asking the question, how do we increase the net worth next year? Every club wants to do that. And I think it's a very easy, I do a lot of presentations to boards of clubs, and when I put this concept on the table, there is complete unanimity and heads moving up and down. When I ask the question, should the net worth of this club increase over time? Everyone's head shakes yes. And when I ask, does everyone understand what net worth is? Everyone's head shakes yes. It's a very simple concept. Everyone gets it, and everyone gets that it must increase over time. So with that as a foundation, let's take a look at maybe a different view of the budget process. So again, this is our financial insight model. The typical approach in clubs is to start with the operating ledger and kind of work down, project revenue, project expenses, project the operating result. And as I said earlier, my estimation is at least, I think I'm being gracious, but at least 80% of the time, the finance committee, the board, the staff, all tied together, is focused on that ledger. But very little of that money is going to end up in the capital bucket, whereas the capital income is the driver. So the typical approach, is kind of starting on the operating budget and work down. Let's see if we can start on the capital budget and work back up to the operating budget. So this is a club where we show the net available capital, which is the earnings before taxes, depreciation, and amortization, in the blue line. So last year it was 12% of the operating revenue. And the depreciation, this is a chart, a standard chart in the club benchmarking reports. It shows the depreciation at 15%. So there's a gap between the amount of money the club's generating and its depreciation, to the tune of 3% of the operating revenue. This is the club that had $3.9 million in operating revenue. I'm going to round it to 4. It's easier math. 3% of $4 million is $120,000. So last year, this club's net worth shrunk by $120,000. But if you recall, it had a $30,000 operating deficit. So the reason that it shrunk, the main reason, is because it didn't have enough capital income. Even though the capital income looked healthy in terms of the benchmark, it wasn't enough to overcome the depreciation. So that gap needs to be closed. As long as that gap exists, this club's net worth will decrease. And I'll take a minute now to talk about a little bit about depreciation. When you look at depreciation in a club at any given point in time, obviously it's an indicator of the past, not the future. The depreciation number reflects the value of assets that were installed at some point in the past. Those same assets are going to have to be replaced or repaired in the future, and it's an obvious conclusion to say that it's more expensive to replace and repair them in the future than it was to originally install them. So even a club that meets the depreciation number, where the net worth is flat, is falling behind because it won't have enough to replace the future value. It has enough to replace the past value. And that can be significant. If you think about a club that built a clubhouse in 2000, maybe the clubhouse in 2000 cost $8 million to build. You build that same clubhouse in 2030, or 30 or 40 years later, or renovate it, do a major renovation, it's not going to be $8 million. It's probably going to be $25 million. So there's a 3x increase there. Not everything might inflate at the same rate. But the point is, Your net worth can't be flat either. It actually has to grow, and it has to grow, I contend, at a rate greater than inflation. Inflation's running around 2.25% over a period of time. So, you know, clubs that are going to make headway in terms of real costs have to have an average annual growth rate in net worth of at least 3%, we believe. This club doesn't have a growth rate. It actually has a shrinking rate. So this club's about 6 percentage points behind where it needs to be. Just check and see if there's any questions at this point. I love questions.
We just had one question, Ray, and that was, will the deck be available? And my answer was that we'll distribute the recording of the session, but I was unclear on whether we'll be distributing the deck itself.
Okay. We will distribute the deck if someone requests it, yes. This different approach is at looking at it from the capital ledger back to the operating ledger. So I'm going to ask a bunch of what I think are catalytic questions. I don't know if I spelled that correctly now that I look at it. But what about these questions? I think every club needs to ask these questions before they start the budget process this year. What has our net worth been doing over time? And by the way, pause there. If you reach out, we will send you a template, or you can put it in our website. We have 2 different ways you can submit the data. It literally takes 20 minutes to submit the net worth over time data. If you do that, whether you subscribe or not, we will send back a benchmark that shows your net worth over time in comparison to those clubs that I just showed you. So that's a very valuable view. Frankly, it can be an eye-opening view.
Ray, we did just get a couple extra questions here, if you want to do that now.
Sure.
The first question is, what happens if a club doesn't depreciate?
That's a good one, and I know there are a couple of clubs that expense their capital. I've run into 1 or 2 of them, and I will say I'm going to think on my feet, and I'm going to address that at the end because it takes a little thinking. What's going to happen is they're going to have. It depends on how they invested in the assets that they have. You know, if they took capital income and they expense it all at the same time, the net worth won't change in that particular year. Say you invested $1 million, or you generated $1 million in capital income, and you expended it on a capital investment for $1 million, and you didn't book it and depreciate it. You just expensed it that year. Well, your net worth would be flat for the year. So I don't think that you'll see, over time, I guess it'll be the same. If you're generating the capital income necessary to meet your capital expenses, then you'll see over time you'll see a similar trend in net worth. But if you're not generating enough, you'll start to see your net worth decline because the expense will be greater than the income.
Okay, now the questions are coming in. The next one, I don't know if it's a question or a comment. It just says accelerated depreciation on the books. I'm not going to say that I'm a depreciation expert. I think that most clubs obviously have an accounting firm that does a review or an audit at the end of the year. I would say there's very standard IRS measures for certain types of physical assets that would, in their world, conform to a certain life. Like a clubhouse will have a 30-year life or a 40-year life, and a golf cart might have a 5-year life. There's tax laws that relate to for-profit clubs where there may be opportunities for accelerated depreciation in a way to hide profit, or not hide, but cover profit. But in the not-for-profit world, I'm not sure how that would make a difference other than the clubs choosing to accelerate depreciation, kind of like the club that just asked about expensing it. That's the most accelerated form of depreciation. Okay, and one more. The question is, would a reserve study or reserve study/fund be a better indicator than depreciation?
Absolutely, because a reserve, without question, in fact, I'm going to get into this in a little bit. It's a good question. I'm going to get into it in a couple of slides, but ultimately a reserve study is a analysis of the future cost of repair and replacement. So it looks into the future as opposed to the past. Depreciation looks backwards, and a reserve study done properly by the right folks that understand looks forward. So it's a very powerful tool. In fact, we contend it's a necessary tool for every single club in the country.
Okay, and one more. What happens when the local market won't let you raise initiation fees or members just refuse to pay a capital dues assessment?
That's a very good question. And I think, Terry, please remind me, because I think what we're going to do is we're going to get to that point. That question is the point for the webinar ultimately. And I think at the end, I'll address it again with all of the rest of the data we're going to have. I would suggest, and I believe this passionately, that this webinar is a response to that question in a way to help move members. Members need to understand what's happening to the value of their club before they're going to come out of their pocket to help it. And that's why we look at net worth over time. So this is a catalytic approach to having that discussion.
And this one ties in, how do you suggest clubs plan for and fund a known large capital expenditure, irrigation system replacement, for example, that may be 7 to 10 years in the future?
Yeah, and that's going to be answered too by the end, and I'm actually dealing with that at my own club right now. So those two, if you could, Terry, just I'll circle back to them at the end, but we'll have more data in front of us at that point, and I think I'll be able to answer them very directly.
Yeah, that's great. And to that point, if you have a question in here and we don't get to it live during the webinar, they're all recorded, they're all tracked, so we'll get back to you.
Okay, thank you. I like taking the questions in real time. I think it helps with the flow of the webinar. Sometimes you feel alone when you're talking to a couple hundred people over the internet, but that makes me feel part of a community, so thank you. So these are the catalytic questions, and all the questions we just had obviously reflect this. How do we generate the necessary net available capital? What does the net worth need to be in the future? There we are with the capital reserve study. How much? So my suggestion would be that now we're talking, this group, we get the questions flowing, the thoughts flowing, and we're talking about the capital ledger, not the operating ledger. And that is the important ledger, In a club, assets, or it's not a club, in any business, assets equal liabilities plus equity. That's a simple equation. The left side of the balance sheet is where the money ended up. Obviously, businesses are about money. The left side, assets, is where the money ended up. And the right side, liabilities and equities, is where the money came from. Money flows from liabilities and equity to assets. So the assets are what we have in terms of in a club, and I'm going to show this with data. The basic thing that clubs have, 80% or so, is property, plant, and equipment. The net after depreciation value is property, plant, and equipment. Liabilities is money that comes from others in the club other than our members. Mostly banks. Obviously suppliers in the forms of accounts payable, but I'm more focused on long-term, not short-term right now. So it's banks, it's debt. And then equity, which is in the form of unrestricted net assets in a not-for-profit member-owned club, is the money that comes from our members and from our business with those clubs that generate a significant operating surplus over time. That will contribute as well. So we're understanding where the money comes from and where it ends up. I did a study. I think those who have been on a number of our webinars know we're very focused, and I believe rightly so, on the capital ledger. And we look at capital poor or starved clubs, as we refer to them, and capital rich clubs. So I actually took a handful of each. And this is data from the tax returns that are available on GuideStar, the 990. So this is off of a tax return that was sent into the IRS. And the things that I want to zero in on are the yellow boxes here. So let's start with net worth. Oh, the other point I have to make. I picked 20 clubs altogether, 10 capital poor, 10 capital rich. I've been to every single one of the clubs that I picked, and I picked them for that reason, because they're all 18-hole facilities, and they all have fairly similar footprints in terms of the size of the clubhouse, the parking lot, the pool, the golf course, you know, their footprints are very similar. The average net worth of the capital poor clubs is $3 million. This is in thousands, so it's $3,023,000. The average net worth of the capital rich clubs is $28 million. Now, the next point to look at is the net property, plant, and equipment to assets. So you can see the assets reflect the net worth, which is obviously logical, as we just saw. It's an equation that balances on both sides. So the assets at the capital poor club at the average are about $6.5 million, and they're $40 million in the capital rich clubs. But when you look at the property, plant, and equipment, so this is net property, plant, and equipment on the far right on the bottom. In both sets of clubs, the property, plant, and equipment works out to the exact same ratio, 77% of the overall assets. So what that's saying is the current value, the current book value of all the property, plant, and equipment after all of the accumulated depreciation, I'm going to round it, is 80% of the assets of the club. That's the way clubs work. The money in clubs, now remember, it can't be the operating money for the most part, for the vast majority of clubs, because they're breaking even. The money that's driving that is capital. 80% of that money ends up in property, plant, and equipment in the club, which makes perfect sense. I think that's logical for all of us. Let's look at the net property, plant, and equipment up on the far right on the top table. In the capital poor club, so this is the paper value of that 18-hole club footprint. In the capital poor clubs, its average is $5 million. In the capital rich clubs, its average is $31 million. Theoretically, if both groups of clubs had done the same things over time, those capital poor clubs would have an average close to 31, if not 31 million. So those capital poor clubs, over time, have underfunded to the tune of $26 million. It's a significant, significant number. And I hope, I know I like to beat a horse bloody, but I hope that's starting to, be pale in comparison, or makes the F&B cost of food and beverage, which have nothing to do with any of this. They don't even move the needle in any club. It makes it shrink into the background so that no one will think of it in the future. This is where the board should be focused. In the capital reserve study, to the person who asked that question, the capital reserve study of these two clubs, the two groups of clubs, would be vastly different. The underfunded club is going to show significantly more needs because they have to catch up. And the one that's maintained itself more consistently will still have needs, but they'll be much less because they've kept up. So critical point. And then back to our equation, again, the money, where'd the money come from? Liabilities, others, or equity members. If we go back to the table and we look at the debt to equity ratio, in the capital poor clubs, it's 75%. And in the capital rich clubs, it's 16%. And the point there is this: the members are the ones that have funded the capital rich clubs, and the banks are the ones that have funded the capital poor clubs. And to the person who asked the question about how to get members who resist investing through capital dues in their club, this is the key point. You need to have the property, plant, and equipment if you're going to have a club. And the question is, are the members going to think like customers or owners? In this table, this data, I think, can be an eye-opener. Because in most clubs, maybe in that club, for the person who would ask that question, this data hasn't been on the table, because when we're in the budgeting process in those clubs, we're worried about a line item, for $5,000 and why it went up by $1,000 in this year's budget. But we're not focused on this big picture, this critical stuff. If you think about it, that operating budget is for 1 year at a time. It's transitory. And it doesn't move the long-term needle because clubs are set up to break even operationally. Net worth is where the money that's generated or left over ends up or doesn't end up. So that's the place to start thinking. And I think this table here, for me, it hit me over the head. I started the work, I didn't know what I was going to say. I had a theory. The theory was clearly proven. But you can see it right there. In I'm looking at capital poor clubs here, but this thesis cuts through at least half of the industry. So at least half of the clubs in North America are on the top line, not the bottom line. And not all of the remaining are on the bottom line. That's the upper quarter of the industry. Are there any other questions at this point, Terry?
There are. One question, a simple one. One more time, how do you calculate net available capital?
So net available capital is in the slide that is in our financial insight model, but it ultimately it equates to the earnings. It's when you throw, if you were looking at it on what's called a GAAP basis, generally accepted accounting principles, when you throw all the capital income and the operating income into a bucket and all the expenses into a bucket, not capital investment. It's the earnings before taxes, depreciation, and amortization. Taxes in a not-for-profit club are basically zero. There's not typically much amortization. So it's really earnings before depreciation, but after covering interest on debt. So it's that cash. It's that pile of cash at the end of the year that you can do one of three things with. You can make capital investment, you can pay down debt, or you can put money in the bank.
Okay. We have low initiation fees because of low member turnover. Assessments have been frowned on by members. Should we budget depreciation in the operating budget?
That's an interesting question, and I think that's probably a very logical way of handling it. But budgeting depreciation, ultimately it's the same as asking members to contribute let's say in terms of capital dues. I think that the net worth data over time, if that club would send us the net worth data over time, we'll benchmark it for you and get it back to you. It might be a way to get everyone to see what's going on, because it's probably a situation where your net worth is either flat or declining over time because you can't generate the capital income through initiation fees because you're full and you're not turning over enough members. So that might be a way to start the dialogue in a healthy manner.
Okay. How does the model account for membership numbers full versus declining?
Well, I think that there's no question that, and I'm going to get into this too in some detail in a couple of slides, there's no question that the clubs that have declining net worth tend to be the ones that have declining membership, and they go hand in hand. So what we hope is that this approach, this view, this big picture view, this strategic view, this critical view, is a way to get the current members to realize what's happening. And I think we can prove with data, I'm about to do it, that there's this debate that goes on in many clubs. We know we need to invest, but we need more members before we do it. But the data shows conclusively it doesn't work that way. You don't get more members until you invest. So it's not often in chicken and egg riddles. They can point out what the chicken is and what the egg is, but I'm very confident the data shows in this case the chicken is investing and the egg is more members. It ain't going to work the other way. If you don't invest, if you don't generate the income to invest, you're not going to have members. It's as simple as that. They won't join, because who's going to join a club that's declining? The physical manifestation of declining net worth is shoddy property, plant, and equipment, or outdated property, plant, and equipment. And in the net worth view is a way to shake the membership into action if they have any shred of caring about the club. And if they don't, then maybe that's a club that should just go away, and the net worth data might help accelerate the process, because frankly, there's too many golf clubs, at least in the country. And there is the walk of the wounded or the living dead, whatever we want to call it, going on. But there's some clubs in my particular geographic area where I've looked at the 990s and their net worth is negative. So they're really bankrupt in the end, but they hang on just on a cash basis, but they really run down. So that net worth view can sometimes accelerate the discussion, frankly.
Next question, please define receipts in the receipts to assets column.
Yeah, so I did this off of the 990, and so receipts is just the gross money that's taken in by the club that year. We would look at it as operating revenue and capital income. And what you tend to see is those clubs that have a lower asset base, because they have more worn out property, plant, and equipment, it's probably an indicator. You know, in some industries, you might think sales to assets is an efficiency measure. In the club industry, it's not necessarily that. It's probably more of a measure of you're doing revenue, but you're doing revenue with assets that are worn out, not necessarily more efficient. You can see that the capital poor clubs tend to have a higher receipts to assets ratio. But that receipts, you know, the point being their net worth is not there. Those receipts are operating receipts. They're not capital receipts by definition, because if they were, they'd be able to generate net worth, but they can't. And that's because all they're doing is funding the operation. They're not funding the capital. So, you know, back to this net worth over time, and one of the questions that was asked, if I were a member of XYZ Country Club and I saw this, and I saw our club benchmarked against 150 clubs, and I saw that we were one of the 3 or 4 most rapid declining in net worth, even if I was in a club where it was flat or below flat, it kind of is a call to action, because the only people that can solve this problem and it's half the industry again that are, in terms of real dollars, are flat or down. The only people that can solve that problem are the current members. They tend to be the clubs without an initiation fee or a very low one that aren't attracting enough members to a question that someone asked. And so the money's got to come from the current members, and either they care about the club or they don't. And if they care about the club, who would want to see the value of their business decline over time? They have to think like owners, not customers. That means they got to kick in some money. And I can say this with pretty good confidence. I've seen it so much, but people will argue. I've gotten into debates with people about raising dues $20 a month that go to the first tee and they want to play a $50 Nassau for one match. So let's not fool ourselves. I know some people are stingy, but I also know for the most part, people who belong to private clubs can come up with another $50 a month or maybe even $100 a month. And numbers like that can greatly move a needle. You know, when you think about the capital poor clubs, their asset base is such, or will soon be such, that the depreciation number is shrinking. So you can start to increase the net worth pretty easily because the depreciation number is going to get smaller. So if you generate cash to overcome that smaller depreciation number, you're going to start to see your net worth go up, and you're going to have liquidity and money to make the decision of where to invest it. And once you start that cycle, and this is the key, the decreasing net worth fosters a wait to invest cycle, wait for more members. That isn't the way it works. It works the other way. Increasing net worth, which means generating excess capital income, is allowing you to drive investment, and that investment will pay itself when folks who aren't in the club are willing to join because of the value proposition, and they're willing to pay to join. And that starts the ball rolling in the right direction. There is no question that there are 2 cycles that exist in this industry right now. One, which I'll contend is about a quarter of the clubs in the country, are on the left, where they have it moving in the right direction and it's feeding on itself. Carmel Country Club is one of those. That's why their net worth's increasing. They have a significant amount of initiation fee income every year. They have a large member count, and their churn is, unlike the club that asked the question, the churn is enough that if they can have 50 or 60 members come in a year, they can generate a significant amount of initiation fee income, and it allows them to invest. Versus the clubs who have decided to wait, they're not going to see anything change until they invest. They're in the wrong cycle. They're in the negative cycle. And what they're going to see, and if anyone feels that they're in a club that has this situation, the proof point is there. It's evident. It's indisputable. Send us your net worth data. We'll send you back the benchmark, and it's indisputable data that says to the board, to the members, folks, we're letting our asset wilter and die. We have to do something about it, and what we have to do about it is come up with more money.
And I just summarize that. I've been in both of these clubs, and as I said, Carmel's been focused on investing and raising the value proposition, and it's paid for itself with a consistently increasing net worth. The other club's focused on making money in F&B, very little discussion of the value proposition, and frankly, creeping irrelevance. The members act as customers, not owners, and they use debt to make investments. If you use debt to make investments, investments increase your depreciation line. If you don't generate the cash to cover that extra depreciation, your net worth's going to decline even more rapidly because you didn't have a base that was greater because you made the investment with income. You made it with debt, and that's exactly what happened at this club. So in conclusion, and this is, I think a really important point. While operating budgets are obviously important and necessary, they're transitory, they're specious, they are generated essentially to run around break even. So they're not going to move the net worth of a club's needle. There has to be a balance in the budget process between operating and capital. As you go into your budget process, just take stock of it, take inventory. My guess is that most of the finance committee members are going to want to talk about some line items on the operating budget. There's a lot more line items on the operating budget than there are on the capital budget, but it isn't the important one. The important one's the capital budget. We really need to get the staff to manage and take responsibility for the operating budget. And we really need to get boards and finance committees to focus much, much more intensely on the capital budget, as I just proved with net worth data. I suggest that it should be 1/3 operating, 2/3 capital if the club's healthy. And the staff can make the gap up on the operating. If you have a net worth declining over time at your club, and again, I'm pleading for data. The more data we get for this, the better it gets for everyone else. But if you have a declining net worth, it's very likely, and I would contend, I'm going to say 100% certain, that you're overly focused on the operating budget. How else would you let the net worth of a club decline? It's a powerful view to document it over time, and it can really kickstart, and this is to answer that question about how do we get the members who don't want to contribute. This is the way. I believe this. Have this discussion, show this data, show it in comparison to other clubs. It's a way to at least kickstart the discussion on how to generate capital income to move forward. And it's a real easy process. All we have to do, we saw the gap between net available capital and depreciation on one slide. It can take literally 8 minutes to calculate it. And all of a sudden, you know how much capital, net available capital you need to have next year to increase the net worth, and boom, now you just got to divide it by the number of members. And most clubs that are declining in net worth, that number per month is not going to be significant. It's going to be manageable. It's going to be acceptable. People will embrace it. And that's what I have, and I'm hoping, finish pretty much on time. I'm hoping there's a few more questions. We have a few more minutes.
There are lots of questions. I'm going to backtrack here. The statement around customers versus owners really resonated for quite a few people. I'm going to kind of blend these two questions together, or comments together. While planning is essential in both types, do you have any different thoughts on a privately owned club as opposed to a member-owned club? Our members definitely think more like customers, users, rather than owners. And then the other comment that I'm melding with that is customers versus owners. Good comment. Clubs of the future, doesn't the industry move more into this segment with members being customers rather than owners?
Okay, to the first part, I think that there is someone who owns that club, and I would suggest that, I'm just going to jump back to the slide. I would suggest that these two cycles work identically, whether the club is member-owned and not-for-profit, or owned by an individual or corporation and for-profit. I would suggest that the only way, if over time, and it's the same, by the way, for both businesses, you're both trying to generate cash. One of them, the for-profit club, some of the cash can go into the owner's pocket, but obviously some of it's got to go back into capital investment. The other one, the not-for-profit club, it can't go into the owner's pocket. It just goes back into the club or into reserves. But the way you generate cash in excessive depreciation is the same in both clubs. The catalyst for growth in net worth or growth in profitability, if you will, is through investment. You have to invest in your value proposition in order to attract, and retain. And if you do that, you'll see the financial ramifications will be positive. If you don't do it, they'll be negative. Even if it's a for-profit club, you might be able to pull cash out of it for 5 years or 6 years, and that might be the strategy. But if you just pull cash out and you don't reinvest, at some point you'll have an asset that's not worth a heck of a lot of money. So it's a balance between now and the future, and in either of the two clubs. In terms of the second part, over time, clubs moving towards models where members are more customers than owners. I think that there's clearly consolidation in the industry in terms of private equity firms or companies like Club Corp. That consolidation, I'm sure, will continue for clubs, and ultimately probably the consolidation on the margin. I'm not saying all of it, but the consolidation generally occurs with clubs that have gotten themselves into net worth difficulty, without investing over time, and the folks that come in have deeper pockets, so they can move the ball forward by making investments and kickstarting that cycle. But I think for those clubs, there were many clubs. A big chunk of the industry will probably always have owners as opposed to customers. And for those clubs, all of these tools, this long-term view is the critical piece of the puzzle.
Okay, next question. What would be the optimal length of a capital plan?
I think that it's a great question. Another point, and something that club benchmarking is really beginning to focus on now, is one of the reasons that this net worth decline over time has occurred, or flat growth in it. I should have made this point earlier. It's the focus on the operating budget, and it's also the focus of 1 year at a time. The vast majority of clubs really have 1 year budget at a time. They don't plan forward. So clubs should really have 5-year pro formas at a minimum, in my mind. Ideally, capital reserve studies at 20 years in the future. It takes a lot of time to raise capital, as we all know. In clubs, you can't flip that switch overnight. So the longer term view you have, the more time you have to prepare and the better off you'll be. So I think a rolling 20-year capital reserve study, so a capital reserve study that's updated every 5 years, that always looks 20 years in the future, integrated with a comprehensive 5-year pro forma that's both operating and capital, that would be a really solid financial foundation for a club.
Okay. Why do you label this a top-down approach? Questions are coming in so fast that it's jumping on my screen. Hold on. Why label this a top-down approach? I would label this a bottom-up approach. Clubs need to define what dues should include, operating expenses, P&I payments, and annual cap replacement costs.
I think it's a great point, and I have to say, whoever made the comment, I agree 100%. As I did the work on this presentation, I realized that it was a bottom-up approach in terms of our ledger, as we all saw. When Terry and I were coining the title for the webinar, the top-down was more reflective of strategic versus tactical. So I agree. It is financially a bottom-up approach. You're working from the bottom line and working up. And when we coined the title of the webinar, I was thinking more about strategic thinking with the big picture in mind first, rather than the little picture. So great point.
Right. Okay. Would excess or deficiency of revenue over expense be the same as net worth?
It is the change in net worth. Absolutely. So when you look at typically you'll see in not-for-profit, you'll see the total revenue, and you'll see at the end of all the expenses, see the excess of revenue, which is either negative or positive. If the excess of revenue is negative, your net worth declined. It will decline amount equal to that number, and if it was positive, it will increase.
Okay. In the absence of assessments, are there ways for clubs to raise money for improvement, such as debentures to members?
There are, but it won't increase the net worth of a club. So if you take two clubs side by side, one does it through an let's say two clubs down the street from each other are making a $5 million investment. And one does it with an assessment and one does it with debentures or some form of debt. The net worth of the one that does it with an assessment will have grown by $5 million. The one that does it with debt, the net worth won't have changed. They will both, if they were the same investment, they'll both face the same depreciation headwind in the future. The only way that was an effective financial decision is if you generate enough capital income to overcome the increased depreciation that fell alongside the investment. If you don't do that, let's say, and that's the sample club I used, by the way, that did it with debt. What happens is if you can't generate capital income because of that investment, that depreciation number got larger, and you still have your low base of net worth. So your net worth's going to start to rapidly decline, right? Because you're working off a lower base. The club that did it through income and an assessment has a higher base, so it will still decline if they don't generate enough capital income. It'll just have a bigger base. You won't go bankrupt as fast, ultimately. But it's a reasonable thought. I think using debt to kickstart the investment cycle it's a rational consideration. You just got to make sure that you don't take on, obviously, too much.
Okay, I think that's it. A lot of requests for information on how to send net worth, which my response is I will send those instructions after the webinar. That'll be included in the follow-up email.
And everyone that sends it in is going to get a net worth benchmark back from us. It's a pretty straightforward process. It's incredibly invaluable data, and it just helps the whole community. It helps move us all forward because we'll just have more data in the database. So I plead with everyone to do that.
I think that's it.
Okay, well, thank you, everyone. Have a great Thursday afternoon, and we'll talk again soon.